Hi everyone, it's Grant Abbott speaking, and I've got my wee team from LYD Docs, both Laura Gray, our operations manager, and also Anusa Cadnis from Philippines, who looks after all our social media. So they'll be answering any of your questions. Hopefully you can hear everything. And today we're going to have a look at what happens in terms of a SMSF estate. But also want to have a look at what to do in the event around the whole estate planning inside self-managed super funds. We see a lot of pretty glib headlines in the trade presses about BDBNs or alternatively SMSF wills, which both now been bandied around. I think when I first came out with the term SMSF will to put in place 5 or 6 directions that was sort of knocked on its head, but now it's almost de rigueur. So just simply for me, it's an easy way to explain things to clients. So let's get on. We've got a little bit of housekeeping. I think this is just probably pretty typical for most of us. We've got quite a few people here, so use the chat as you see fit, which many of you do. Say hello to us at all, because we love to get everyone on board. Tony, I'm not sure why, Tony, you haven't got a direct link, but good to see Mr. Anamoulis is there, and also to you as well, Manish. Put in chat, Q&A. If you actually want to ask me a question and get me to respond to it, don't go into the chat, use the Q&A, because that's the only thing that I have a look at. Our team monitors the chat room. If you have to jump away, that's fine. Quite often we get a number of registrants, but we don't get everyone on at that time because things just happen. But just know that you'll be getting a copy of this recording at the end of the day, and there'll be a couple of materials as well. They'll all be uploaded later this afternoon. You get a link. Very exciting. We've been talking about it forever, but we're now in our position that LYD Docs 2 is currently moving towards the final phase of integrations, and we've integrated with ASIC now, which will enable you to get ACNs and companies within about a minute or two. So it's quite an amazing system, ABN TFNs, BGL links, etc. So we've got a lot coming down the track. We're looking at that launch is going to be around about the 1st or 2nd of November. So watch out for that one. We've currently got 30 firms going through beta testing for that. So that's pretty exciting. Now, in terms of self-managed super funds, it's getting to the stage now that when I first started doing them in 1994, that really there wasn't any instance of being that they really looked at for estate planning tools. And it really, even up to 2007, they weren't really looked as big estate planning tools. And the reason for that was that essentially Regulation 621, up until that point in time, required that where a person died, their death benefits had to be paid out as soon as possible, which is still the case, but at that 621 also basically provided that where you were retired, your retirement benefits had to be paid out as soon as possible, so that effectively that retirement definition was thrown out. So really 621 focuses solely on death benefits, which is also important because it means that we can set up, and it's very unlikely, but we can set up a self-managed super fund solely for retirement purposes. So that means that we just lock it up and don't put it in a pension, leave it in the accumulation phase. And then going down the track from there is that if you don't need to draw upon it, then it just simply accumulates and is going to be set up for the next generation. Whereupon from that, you're going to then build an SMSF will. Now, this is pretty important, is that, from my review of all the ATO stats, and it's quite interesting to see that we're now up around about $820 billion. So we're over, unless there's a huge correction to the market. And I would say that there's a lot of undervalued properties inside SMSF. So my feeling is we're up around about the $900 billion mark. So we're closely really starting to get into that $1 trillion mark at some point in time. But really the people under 50 are very underrepresented in terms of the coin that is actually inside self-managed. So over the next, if you have a look at the 65 plus or the age 60 plus stats, and assume that over the next 20 or 30 years, a lot of those people are going to pass away or die or whatever, then in those circumstances, we need to really go down the track of getting that estate planning in place. Traditionally, the BDBN has been used, and I'll cover that a little bit later on, but I'm not a big fan of BDBNs unless they've been properly crafted. And unfortunately, the ones that come out of most systems are really very ineffective. Now, this sort of gives a, and this is not a bad idea anyway for all of us to have a look at. And I started in the SMSF. I was in my first SMSF with mum and dad in 1994. They were part of that builder generation, and that's the war generation. And Dad had a bit of super from working as the CEO of CGU, or in those days, Commercial Union Insurance. I came in on part of that boomer generation, so I've been in there for quite some time. But what's happened is everything's now starting to move down the track. The builders are gradually, they've got reasonable amounts, some of them inside SMSFs. There's not a huge amount there because really SMSF sort of started around here and then took there and starting to move down that track. With the boomer side, a lot of the boomers have got reasonable size self-managed super funds. So between these two, we're going to start to see there's going to be a passing of the baton over a period of time. I'm going to show you a little strategy going on very shortly in a case study, how to keep assets within SMSF and then hand it down to the next generation and next generation to use. So we've got a fairly strong flow there, but really in Australia, if we have a look at this, and it is a bit unfortunate, but in the long run, within here we've got a good $9 trillion of property. We've got probably $300-400 billion of superannuation monies, and they're all going to be passed by way of the estate planning process, over the next 20 or 30 years. And no doubt all of you having clients pass away on you and really not knowing what to do. It's very easy when you have a look at from an estate, you go down and get probate, but for an SMSF, most of us believe it's quite a difficult process, but it's actually, it's not that difficult at all. So from our perspective is that if you're looking at where to operate or play, down in this area, that estate planning area is really important. But as I said, there's $9 trillion of investment and homes. Really, from that perspective, is that if you just focus on SMSFs from an estate planning, it's fantastic, but there's more to it. We need to have a look at what happens with our discretionary trusts, other investments that we have, family provisions claims, and obviously SMSFs as well. So they all have a really good place in the sun. Let's have a look at some terms. Estate planning versus SMSF estate planning. They are quite separate, and I'll show you a little bit later on the Commissioner's guidelines around that. But essentially, from our perspective, is that right up front, the estate planning that we do through our will is governed by state-based law, whether it's, for example, in the New South Wales, it's a Succession Act. Whereas if we're dealing with superannuation, we're dealing with Commonwealth law. So they're completely two different styles of law. Under Commonwealth law, there's a lot stronger claims and ability to sue in terms of loss or damages that may not be available under the standard or the traditional state-based law. So when we deal with it, one thing though is we've probably all seen in the past is that where our clients go to lawyers and start talking about estate, traditionally superannuation, and I want to take you away from that. Traditionally, superannuation is passed over to the estate. Now, the problem about that is that's fantastic, but I've gone from asset protective, a low taxed environment, and then suddenly I'm throwing it out over into an estate where it potentially can be challenged under a family provisions claim. And even for some of you who've seen and read a couple of the, I think it's is it Kelly's case in New South Wales, that even this notional estate concept can eke out or start to move into superannuation. Personally, I believe Kelly's case was decided correctly from a state-based family provisions claim, but I was very surprised the lawyers didn't claim a constitutional issue that really state-based law can't impinge on federal law. So when we have a look at it, we've got our traditional estate planning, our SMSF estate planning. We want to be looking after dependents directly from the superannuation fund. I don't want to see anyone who's a dependent, I'll cover that a little bit later on, anyone who's a dependent going over to the estate. I'd rather see it being looked after by way of the directly through your SMSF will or alternatively your reversionary pensions. A will versus an SMSF will, which is quite obvious. A will is dealing with your assets sitting outside self-managed super funds, sitting outside trusts. For example, we don't have at all in Australia, although it is coming, we don't have in Australia effectively a will that leaves assets to the next generation under a trust. Once LYD Docs 2 comes out, we'll be launching our lifetime. Actually means that mum and dad can be in there and then leave directions to split that trust between the next generation. And to me, it's fantastic because if it's done properly, there's no capital gains tax or stamp duties, and you still got that ability to have that really good, strong trust structure. So for those of you who already got that leading member trust, it'll just be a simple tweak to that trust to enable that second and even the third generation to pop in there. So it's almost akin to building testamentary trusts within those trusts. But going apart from that, if we have a look at it, it sits completely outside our will. So your wills can't dictate what happens inside the trust. Although it's surprising to see how many wills we have a look at where they try to dictate it, and it just doesn't work. Because if a will tries to dictate a trust, that means a family provisions claim can also eke into it as well. So you just don't want that at all. BDBNs are dangerous, mainly because of the way that deeds quite often are drafted. It's not the BDBN itself that is the problem. So binding death benefit nomination might be, provide this for this person 100% here, or provide a farm here for this child, or provide this investment property, or someone's to get 100% of my estate, my spouse to get a pension. All of those things are fine inside a binding death benefit nomination, but it's the way it's tied back into the deed. For example, if you have a look at a whole range of cases, Katz and Grossman, Donovan and Donovan, in Katz and Grossman, it basically fell because although there was a binding death benefit nomination, it failed. The deed said it had to be an approved form. So although they came up with a great binding death benefit nomination, that form had never been approved by the trustee of the fund. So if you are offering a binding death benefit nomination, it needs to be tied into the deed, and most SMSF lawyers will discuss that. Although it's funny that you'll have a look at commentators saying BDBN or binding death benefit nominations are a regularly understandable term. I would say that if I pulled 100 people, in fact, if I pulled 1 million people in Australia, did a survey on them and asked them what a BDBN is, a binding death benefit nomination, none of them would have any idea. Whereas if I said for those, and I pulled out 1 million people with the self-managed superannuation fund, and I said, well, what do you think an SMSF will is? Then I would say 9 times out of 10, maybe less than that, that they would refer to it being a will over your SMSF. So again, remember, if I'm doing an SMSF will, which if you're using, and again, SMSF wills can be rubbish like a B2BN if they're not tied into the deed. If you're using an SMSF will under the Abbott-Family and LYD Docs platform, then essentially there's 6 components that fit within that SMSF will. So a B2BN just normally talks about a percentage of money going to such and such a child. We don't have that issue with an SMSF will. So the first thing is to work out whether prior B2BNs or SMSF wills are to be revoked. Absolutely. Then to have a look at whether if you have a reversionary pension, does that have precedence over an existing SMSF will? So for example, if I've written a pension that goes from John to Sally, then to Max, for example, which is the son. Now, the son can't take the pension, but can take the commutation. So he goes to John, to Sally, then to Max. Then in that instance, effectively, that pension just carries on. Whereas if I've written in my B2BN or my SMSF will that this is to take precedence over that, it means that on death, potentially my order reversionary closes down, everything moves over to the accumulation side, and then we have to deal with things there, which creates potentially a tax problem from that if we're closing down our pension side. And likewise, if I've got a couple of pensions there, one tax-free, which I'm going to be distributing to Max, remember, so it's going to go John, Sally, Max. Max is the adult child, so I want to give the tax-free pension to them, so when he receives it, it's going to be tax-free, whereas I might have John to Sally. So in that instance, if it goes to Sally as taxable component, then it's okay for her. If she took it out as a lump sum, then she's not going to pay any tax because she's the spouse. So again, we just got to be careful about that. So that's the second one. Third one is the appointment of you as a professional advisor. And this is really crucial. And to me, it's the big standout difference between this B2BN and SMSF will or other people's SMSF wills. Again, if I have a look at the SMSF will, it's generally guided by federal law, whereas a will is, again, state-based law. B2BN's, again, federal law. When we come around to looking at that forward-looking contract that you're going to be the administrator of the SMSF estate, which you're entitled to do so, then that becomes a contract between the trustee and the future trustee and yourself. Importantly from that is if the future trustees bin you, then you've got a right to sue under contract under the federal law for loss or damages. So again, we want to put our details in there to be the administrator of the SMSF estate, because generally a lawyer is not going to know how to administer an SMSF estate. I'm going to give you the lowdown very shortly. So again, remember, the first one is, do we want to revoke? Second one is then, do we want a pension to take precedence over SMSF will? And because there's so many tax and estate planning issues by doing that, it's better off keeping, if you've had the temerity and the thought and the strategy to go through the retirement income stream, then stick with that. So you tick the box. Third one is put your name down as obviously being the main person or being the provider. Then we've got to actually start to look at the pension, the estate planning benefits. How are you going to, complete those? What are you going to do? Are you going to have 100% to the spouse? But then what happens if the spouse is not alive? Are you going to make sure it has to go as an income stream to the spouse? And you can create the sort of income stream that, for example, is more akin to some of you are older, the allocated pensions, so that if it goes to a second spouse, it might go to John, then to Sally, or if it's a startup pension, goes to Sally, but she must take a minimum, but there's a maximum pension payment. It's non-commutable. So you're preserving your capital that then can go over to Max. It might not be a child of Sally and John's marriage, but maybe John's first wife. So when we have a look at that, death benefit lump sum, I think most of you are pretty well aware of that. If you've got an asset sitting in there, you might be able to do an in-specie distribution. There is a bit of a quirk in there that death benefits need to be paid. So that may create an issue that if you're doing in specie, if you're concerned about that, then what you can do is effectively pay at a promissory note, which is akin to a payment, and then use that promissory note to then buy an asset directly out of the superannuation fund. Testamentary trust versus SMSF proceeds trust. So when we have a look there, testamentary trust comes out of a will. SMSF proceeds trust, if you go through into the estate, which opens you up for obviously a family provisions challenge, then in that instance, that may well be classified as, you might have heard it, a super proceeds trust. However, we know from our learning that in terms of dependents under the SIS Act, so putting aside tax because that's obviously tax consequences, a dependent includes obviously spouses. It has to be a current spouse, doesn't work for former spouses, unlike the tax rules. Also includes all children, and also includes people who are in an interdependent relationship if you're caring for them. You've got a commonality of relationship, and then includes also financial dependence. So they're the four key criteria there, so that we can pay directly out of the SMSF estate directly down to a dependent. So, for example, if a grandchild is financially dependent, we can pay it directly to a grandchild. But if they're only like 6 or 7, you're not going to pay that directly. What you'll do is you'll pay a lump sum to them, and then what will happen is they can then use that money, or the trustee of the SMSF can use that money to set up a SMSF proceeds trust or a death benefits trust. So that is settled directly into that trust there. And it has the same benefits as a testamentary trust in that even though it might go down to a 6-year-old, again, we have to show that 6-year-old is going to be financially dependent, but is taxed at ordinary adult tax rates. So the penalty rates for children don't apply in that one. So that's the two there. But the benefit of that is it does go through directly from the SMSF, not into the estate. This goes through there, but again, is subject to a challenge. Again, SMSF proceeds trust is looked after by the SIS Act, Commonwealth law. Testamentary trusts are not. The ideal SMSF estate planning setup is, again, having accumulation, pensions, so on and so forth. So let's just have a look at a couple of questions. We'll go from there. Graham, thanks for that. Did you happen to see an article from DBA lawyers about B2BN and SMSF will? Look, I've had a chat with Dan on that one, and he doesn't have any problems with our SMSF wills, but he does have with some others. It's quite funny actually, because I did an article on this in SMSF Advisor, why B2BNs are dangerous, and that really comes a lot from Dan. And I used a excerpt directly from there, which Dan said that basically every B2BN that he sees that comes across his desk effectively is incorrect or wrong. So again, it depends on where you're going, and there is, a properly drafted B2BN, and I'm sure if you went to Dan and got that, it'd be perfect. And same with the SMSF will. Through our process, we've taken a lot of the guesswork out as well, and it's tied into our deed. The problem is if you're trying to use our SMSF will or Dan's B2BN with someone else's deed, that's a problem. You can't do an SMSF will if it's not allowed under the deed. So generally, it doesn't matter who you're doing, you want to upgrade the deed, because then it becomes focused pretty seamlessly. It's exactly the same as if you've got a discretionary trust and trust distribution minutes. It's always best to have it from the same provider, because in that instance, they're actually going to both lock together from a compliance perspective. And again, love Dan, and he got up me and said, look, that there's nothing wrong with our SMSF will. There's nothing wrong with his B2BN, because I had a crack at his. But anyway, I just find when you're talking to clients, it's a lot easier to for them to understand what an SMSF will is rather than the B2BN. It's easy for us because we've been around it for a long time. But if you had a look at it, it's only, I think, around about 2010 where the Commissioner and Donovan basically said that BDBN rules sitting in the SIS Act don't apply to SMSFs, and that creates a huge amount of confusion because there's still a lot of BDBNs out there, and more importantly, deeds which require that any BDBN has to be 3 years. So you've suddenly got this lapsing versus non-lapsing, which is, again, it's confusing. And it's a little confusing. We get that from our advisors. With ours, our SMSF will, there's no such thing as a lapsing SMSF will. Now, there may be one that's revoked, which is why we put that question in an SMSF will. If you want to change it, you just go in and revoke the earlier one, but it doesn't lapse, which is important. John, this is going to be a worry because John always asks me hard questions. But a male client age 61 will soon retire, has Q Super of 800K, no BDBN. Can I do a super will, leave 50% to new second wife, leave 25% to each adult child from the first marriage? Absolutely, if you're using our SMSF. If the money's sitting in Q Super, what you need to do is go and have a look at what the BDBN allows. Usually you'll only find that it's going to be a percentage there. Now, what will happen is if you get the BDBN there, make sure obviously theirs is tied directly into their deed. So you should be okay with that one. But then again, you'll generally find there that Q Super will still fossick around and look for other dependents. But if you got that, then you should be okay. So really that's an issue for Q Super. You can't do an SMSF will. It's always going to be a BDBN because that is their documentation that's tied in. And just remember, Q Super is actually caught under Regulation 617A and Section 59 1A of the SIS Act. So you have to have a BDBN, and you just got to watch out whether it's lapsing or non-lapsing. So you're going to have to do one every 3 years. So again, always best to have it in SMSF. I'll have a look at that. I'm just worried about our timing. In fact, I might, yeah, so this is more of a strategy. So what I'll have a look at here, actually, no, I'll just run through it pretty quickly. So we've got a family SMSF. So this is quite an advanced one for people who've already set things up quite properly. And I'm going to take you through, there's lots and lots of strategies in here. So let's go through and I'll highlight the strategies and I'll do it really quickly so you can come back and listen to it again when the materials are set out. I've got a good blog tomorrow, all on this death benefit stuff. So just watch out for that blog tomorrow. So I've got a family SMSF leading member, John, is age 70, his spouse, Sally, age 66 in the Smith family fund. So that's okay. They work in graziers, but have transferred the farming business to their son, Matthew, age 40, who's also a member of the fund. So Matthew is a dependent for SIS purposes. So we can take a lump sum for Matthew, but he can't take an income stream. John has a weak heart. The family's worried about him, but he says he is strong as an ox. More like a donkey, says Sally. So that's Grant's bit of attempted humour. Now, this is quite strategic, I feel anyway, long run short, but the farming property sits in the family SMSF for the benefit of John and Sally, who are both retired, have pensions with reversions to each other, then to Matthew upon their death to ensure the property is transferred to the son working on the farm. So again, so what we would do there is we have the pension, and if you haven't seen that, we'll put a link, if you can remember, Laura or Nisa, I'll put a link into the reversionary pension webinar I did a couple of weeks ago. So to go to John, Sally, and also Matthew. At that point in time, we would also do what we call member-directed investment strategy. So the farm is backing that underlying pension. So again, the farm is backing that underlying pension. So it goes from John to Sally, and let's say Matthew's got his discretionary trust outside, so he's continuing to pay rent in there, which is fantastic. So that will provide that income stream. Now, when Sally dies, it goes to Matthew, and I'm going to cover this a little bit later on. But Matthew obviously can't continue the pension. It'd be fantastic. So it needs to come out of that superannuation fund. And because it's coming out of the pension side, there won't be any CGT if it's done correctly. Stamp duty, it will depend on which state it's in. In some instances where there's a distribution to a beneficiary, there's no duty. Queensland, there is going to be a duty for there. So when that comes out, it's going to be transferred by the trustee of the fund directly to Matthew. So to give you an idea how quickly this can happen, and this is why it's important for you, the administration of your estate, if the farm was sitting outside, and you wrote a will, it's to go to, Sally with a life interest, then to Matthew. So we go down that track, that's fine. But then we have to go through probate. Then we have to wait, depending on the state, anywhere from 6 months from the date of death to 12 months to make a family provisions claim. So nothing can happen really until that point in time. Let's say Sally's not around, so Matthew wants to put it in his name or wants the executor to. What happens if there's a challenge there at a later stage? Then that's completely different, because if I take you over to the SMSF side, then we've got John dies. Assume Sally is predeceased John, then that pension carries on in Matthew's name. So at that point in time, what will happen is virtually overnight, the trustees can have a meeting, and that will be obviously Matthew, who this is why it's important to have that longevity inside the fund, and Matthew to be an ongoing member, because he can then control that fund. He could effectively transfer that farm out directly from the self-managed superannuation fund as soon as you get the death certificate. So death certificate, we're winding up the SMSF estate, bang, it goes out. And that can happen within 24 hours from the receipt of the death certificate, whereas it might take 12 months if we did it outside. Does everyone follow that one? So that's why I love these death benefits. I'm going to take you through the process very shortly. So anyway, that's one way of getting it out, but I'd put the property directly into a family protection trust or a leading member trust, so that when we go out, Matthew would choose to effectively put that out, depending on the state, but effectively promissory note would be transferred to Matthew. We'd set up a family protection trust if he hasn't got one already, which he probably should, or a leading member trust. We'd have someone a settlor, which would just be, one of your secretaries or junior accountants who settle the trust. You then get that the value of the farm, put that in there, and then that becomes now a promise to pay, and then effectively, what you would do is then use that to then go and buy the farm. Again, you might just want to settle the farm directly in there, but again, there's a couple of different processes around it. Farm's worth 2 million. John and Sally's pension benefits sit at one, and anyway, that's not, and they've got a bit in their retirement accumulation accounts. Now, it's just I just want to give you a bit of a different feel for things and what you can do. Matthew has 2 children, Ben aged 17 and William aged 13 at boarding school. Runs the business through the family trust. So we want to always upgrade that to a leading member anyway, and still employs John and Sally. Now that's smart. And this is why. So he employs John and Sally, paying them $70,000 per annum each by way of a super contribution. Now, both of them are retired. So it's all going to be tax deductible to the farm. It's fantastic. Monies are going into the superannuation fund. That money there obviously can't be used to top up the pension, so it'd have to go on the accumulation side. But remember, they can take that money out tax-free. John and Sally have more than $500,000 in dividend-paying stocks in the fund, apart from the farm, and these are used to cover their contributions tax and that of Matthew, plus deductible family trust contributions made for Ben and William, who do vacation work on the farm. So Ben and William, we've got a really good 6-member fund there. If you have a look at it, we've got Marie in there, we've got the grandchildren, we've got John and Sally, and we've also got Matthew as well. Now, if we go down to the next one, and this is just a little thing. So we've put these tax deductible contributions in, fantastic, it's tax relief. Now, John and Sally use part of their pension benefits to pay a school allowance directly to Ben and William to cover boarding and school fees. Now, we've had a bit of success recently, and there's been quite a bit. We're doing quite a few private binding rulings around dependency. And there's been a few that have come back where just paying university fees, etc., are classified as financially dependent. So based on that, if that's the continuation, then both Ben and William would effectively be financially dependent, if that makes sense. So we do our investigation, might need to get a whatever. So the question there is, if we are going to go through this strategy, then what we can do is remember here, we got a pension that goes John, Sally, Matthew, but we know Matthew has to take it out. And this is just something, again, it's a strategic option. What if it went John, Sally, and then jointly to Ben and William? So John, Sally, jointly to Ben and William. If we have a look at that one, that has a completely different complexion. So John, Sally, Ben and William, and remember the underlying investment is that farm. So Ben and William are grandchildren of John, because we only look at John because he's the original pension recipient. So the question is, were Ben and William financially dependent on John at the time of John's death? So we tick that one, so we're quite comfortable with that one. So then if Sally's not around, or even if Sally's around, so it passes on to Ben and William, they continue on that pension. So most of you know that for children, and this is important, so for children, effectively, if they receive a pension, then, and they're not financially dependent, then you can't receive it once you're over 18. If you're still financially dependent at age 25, it must cease and be commuted. And I talked about that with Matthew. That was a commutation. So Matthew is over 25, so he has to commute it. Whereas in this instance, grandchildren, brothers, sisters, nieces, anyone else who's financially dependent doesn't have to commute the pension. So for Ben and William, the pension can carry on ad infinitum. Now, a few things there. The underlying farm doesn't have to be transferred out of the SMSF because it's being used to fund Ben and William's pension. We can still use, we still have to pay rental income for that back to obviously the farming trust, and that would be Matthew looking after that. Ben and William, they just use that income to pay school fees, education fees. We can put terms and conditions around what they can do when they can take a commutation. If they want to keep that farm going forever, we can make those pensions non-commutable forever, so that the underlying farm sits in there as long as the 4% they have to take out is less than the money that's actually going into the super fund by way of rent, etc. So that means that that farm can stay in there. Couldn't for Matthew, but it can if you've got those grandchildren. Now, mind you, once it sits in there, that's their income as well, which is pretty important. So if we go down the track, that's not a bad little strategy to keep a farm in there. The better one too is that because the original recipient of the pension, John, was tax-free at the time, then whoever receives that pension going down the track, it's also going to be tax-free. So for the rest of the holding of that pension and the underlying farm, when Ben and William receive monies coming out of there, it's always going to be tax-free, always tax-free, which is quite exciting for that one. So we've got anonymous attendee, which is fantastic. Wouldn't the reversionary pension from John to Sally cause her to go above her transfer balance cap? Well, it depends. So because it's gone from John to Sally, it doesn't go above her transfer balance cap at that time. You've got a year to adjust. So for example, if it goes from John to Sally, then if we want, Sally could revoke that reversionary, and it could then go straight over to Matthew, or it could go to Ben and William, depending on what we've said with that one. Alternatively, if this was a client, we're just looking at John and Sally, so we haven't done that multi-generational, then if Sally's already got benefits, the way we generally work it, so if you've got John's pension, and we know it's going to be above the TPC, then what we do is we take Sally's pension and then we move that back into the accumulation stage. So that's a really good question. We take Sally's pension, we move it back to the accumulation stage. so that within 12 months' time, we're actually just going to be tested on John's pension to make sure it's under the transfer balance cap. So that means now Sally's got the obviously the pension and the accumulation side. Now, that's probably not a bad idea at that stage to consider anyway, if that money's going to go through to Matthew. And this is what I'd consider is Sally pulling that money out because they go out tax-free and putting that money into a leading member trust for the benefit of Matthew and Marie, the other child. So split it. So then we've got Matthew and his bloodline and Marie and her bloodline as well in that trust. And again, because it's a capital amount, if that ends up to beneficiaries, that'll also come out tax-free to them as well. So that's the strategy that I would use for that one. So again, you've picked up a really good position, but then we've got to solve that and see what we do there. You might want to, most of you might want to listen to this a couple of times to just get a feeling and then effectively come back. If you've got any questions, just let us know. I'll go into the support section. In terms of SMSFs anyway, look, it's really important for this. You've seen, if you haven't seen my piece, I did a pop-up webinar last week on the ability of accountants and also tax agents to establish SMSFs if a client's come through and how we've built solutions for that in light year docs. But for existing clients have got SMSFs, and it's surprising how many I see. People who are really wealthy have got virtually nothing in super. So you want to start to build that around because they are very effective strategies or vehicles for succession asset protection and estate planning. Although I've got 200 billion, I think it's up around about 300 billion and continue to grow. And again, it's not my words, it's actually Dan's words that really, if he's saying only his B2BNs work, then it means everyone who's doing a B2BN effectively can be challenged. And you might have seen a bit of commentary. I know Graham had a look, but there's been quite a bit of commentary in the trade that really the next big growth area is not only challenging family provisions, but also challenging B2BNs as well. I'll just go through this one. So it's very exciting. I talk about, how to deal with your clients, presentations and all that. So I won't focus on that. I really wanted to get in, have a look at this little a step-by-step guide as to what to do on having the death of your member. So the first thing is the client has to die. So that's a pretty good one. And we can speed things up really quickly. So with an auto reversionary pension, and again, have a look, or on Noosa, we'll put that link to the multi-generational later, but that's the easiest. So if it goes from John dies, trustees have a meeting, it immediately goes over to Sally. So that pension now becomes Sally's property. And if she's not around and it goes to Matthew, then it becomes his property. So again, that's the instantaneous nature. You don't have to do anything. It's all the estate planning is actually built into that documentation. So that's why I love it. It's the best. And also stays away from the notional estate inside New South Wales. So don't worry about it, the other states. But if you've got a concern there's going to be a family provisions claim, you're always best to go down that pension route rather than the SMSF will, and definitely not going out to the estate plan. Again, it just switches over straight away. So step one, obtain notification and note from the trustee member's death, which is good. Advice to be sought dependent upon any formal request in the bond, death benefit nomination, SMSF will, or conditional pension, which is just our auto reversion pension. So what we need to do is step two. This is where you will come in. So as soon as you find out the client's passed away, you need to do a letter of engagement. And remember, this is why we put in that you are the SMSF administrator. Put in there a letter of engagement, partner fees, so on and so forth. send that to the trustee of the fund. Now, the good thing about it is you can't take monies from the estate for quite a period of time, but you can start to take monies from the superannuation fund straight away. You can pay out even interim lump sums to pay a funeral. So SMSF, believe it or not, is your go-to place for money on the death of a client. So what you want to do is, again, send out an engagement letter to the client that you're going to look after the SMSF estate and just go straight hourly fees on that one. So if they then kick you out, then you need to say, well, look, this is a federally mandated contract that you've got here and you can kick me out. However, you're going to have to pay an estimate of what our costs would be for that. And you can sue them under section 54C and 55.3 for recovery on that one. So again, this is why you put it down in that documentation. So what you're going to do is the first step, obviously, we look at they're dead. You then send out, I probably should put in here, you then send out that note. Then you're going to check the SMSF trustee. What does that say? You then have to go back and tie in the documentation you've got, whether it's an SMSF will, BDBN, and you tie it in there. Now, you may, it may be beyond your pay grade or you need a legal firm to look after. So again, there could be disbursements there. So you're overseeing the process. Feel free to get Abbott-Family involved. And I know Tony does that quite a lot. So he's a bit of a guru around that administration of an SMSF estate. So we'd review the deed, check the lineage, any change of trustee documents. So, for example, I've just had a look at the discretionary trust recently and found that the original trust setup and also the variation weren't valid because although there were 3 directors, only 1 director had signed the document. So we have to do a ratification for that one. So check the lineage, then review the actual documentation, make sure it sits in there. Remember, we want to make it squeak clean there, because if you stuff up in this one, clients or whoever's missed out has got a right of action for you under 54C and 55.3. So you do your documentation review. Then we need to have a look at what happens there. So, for example, another part of our SMSF will is that the executor, or if you've already put in place a successor executor, that they are to be appointed as trustee or director of the corporate trustee. Now, again, you're going to have to tie that in with the underlying deed. But if you're using the LYD docs deed, then if that person comes in, they're called the replacement trustee or replacement director because they're replacing the deceased director or deceased trustee. They come in, they're automatically appointed, and more importantly, from that particular position, they're the only ones who can vote on the distribution of the SMSF estate. So where we might have second spouses or other people, if you have a look at all the BDBNs, most of the challenges are because there's a conflict between the different families. It wouldn't make any difference here because they're the only ones with power to how to direct death benefits, which is crucial. So again, the importance of having a consistent deed and documentation, whether it's a discretionary deed, whether it's an SMSF deed, whether it's the SMSF will or the trust distribution minutes, makes it really important. So what we're going to do is we want to go in there, and obviously if we're appointing someone, we're going to need to do the tax office appointment notification that this person is appointed as the trustee or director. But as you can see, this stuff can be done pretty quickly. We look at any insurances that might come in. Now, obviously, that is going to be potentially an issue. And when I mean an issue, that's potentially going to be a hold-up into what happens there. But that's not a bad thing. I mean, you can deal with the estate and look after it without the insurances. The insurances can come a little bit later on. But again, just make sure that if you have got insurances, how it's going to be paid out. You determine the member death benefits, so work out, and again, this can be the one that takes a bit of time in terms of, and I just want to go through with it with you. So with the member death benefits, are you going to do your accounts up until that point in time and then pay out death benefits or whatever the member's account is? We're simply going back to last balance sheet date or up to the time the member died. A lot of it is going to depend on what your deed says. A number of deeds basically, well, probably about 60% of deeds provide that when a member dies, that's all they're entitled to. So you have to do a determination at that date and then pay it out. Whereas if you go beyond 6 months for another 6 months, those earnings in that instance would then have to go to other members of the fund. It can't be paid out to the deceased or wherever the dependents are. Whereas if we're accumulating, if you're using our deed, that just that deceased member's estate continues on, and or the SMSF estate continue to aggregate, and still death benefits continue actually paid out. So you want to determine the member death benefits. Try and do that as soon as possible. If you've got any reserves in there, then you can clear out the reserves on death. In fact, you can pay all the reserves out on death, and they're not going to be considered as a concessional contribution. There's a special exemption for that, and that should be, I think it's section, what is it? It'll come to me anyway. So if you have a look at that, there's a special exemption by section 290, I think it's 292.75 or something like that. But anyway, we can pay out those reserves directly into the member's account and then pay that out from there. Value the assets, obviously, in order to get a correct statement there, because obviously if it's going out tax-free, you want to put out as much as possible potentially. Auto reversionary pensions, as I said before, that's the easiest way of switching. We leave that. You might even bring that one up into number, probably post number 3, because you've got that going on straight away. Set up payment schedules so that once you've got the members' values, you start to actually pay out those and who's going to get lump sums and who's going to get in specie. Once that's all paid out, then your replacement trustee or replacement director is required to retire under sections 617A3. And then obviously the final one is, if you've still got pensions, you just carry on down the pension payment. So in short form, death benefit leads to your appointment as engagement, leads to a review of the documentation, sets up the auto reversionary pension first off. Then we do the trustee director appointment. So the auto reversionary pension is not beholden on that. So the trustee director appointment, where the executor is appointed as trustee or replacement trustee or director. Insurances deal with as soon as possible, but they could take some time. Work out your member death benefits. You can do interims if there's insurances, and then you can start to pay those out directly. And then obviously once they're all paid out, we've got the replacement trustee as well. So again, a lot of it's going to be on your documentation, but they're the steps, and you should be able to do those within easily a week to 1 month. And that'll be even before you'll find that most the probate advertisement would even be considered in that case. Winnie, good to hear from you. If it's a 2-member fund with a husband passing on, must always mandatory appoint a replacement trustee director. What if the wife is the appointed LPR? If the wife's the appointed LPR, absolutely. So she'll be in a position of being able to look after both, but she'll also be looking after this estate, so that's fine. But again, we have to look for the worst circumstances. That's why it's good to have these multi-generational funds, particularly even if we've got a 6-member fund there as well. Again, some of the, just drilling down quickly, who actually is controlling the process. And again, I'll have a really good look at these slides because we're running out of time. But get your firm's name on there, because if they bin you're able to litigate. So what you really want to do is make sure you're involved in that process. I might, instead of reiterating, I might just go in here and show you what a SMSF will looks like for those who haven't seen. I won't go into the in depth, so I'll just go Abbott test. And so what I'm doing is I'm just relaunching. It's going to be very exciting with our new LYD Docs 2 popping up. So I'm going to do SMSF will. Okay, so let's have a look here. Oh, so that's the LYD SMSF will. So I'll launch that. And again, I just want to show you what this looks like. It's pretty easy to go through the process here. And again, this is the documentation that will lead to what you do on death. And again, if you've drafted it up, it makes it so much easier. So we've got the fund, that's easy. We've then got the members' details, trustee details. Okay, so these are the six issues that we've got to look at. Does the member want to revoke any earlier nominations? Obviously, yes. Does the member want a reversionary pension or pensions to take precedence? Well, I would say yes always, because remember, that's easy to clean out of the system, and also can give some longevity around it, particularly if you've got those financial dependents. Does the member want to appoint the executor as a replacement trustee or director? Yes, we definitely go yes. So in that instance, Winnie, if the spouse is the executor, then she would fit under there anyway. Does the member want to include death benefit payments? Yes. Does the member want a professional? So this is that issue we're looking at to look after the estate upon the member's death. Absolutely. And if the fund's held non-compliant, you want to catch your clause, you go there. So when we have a look at death benefit payments, I'll just go through here to take you again. So does the member want to nominate beneficiaries? So I'd always go beneficiaries unless they're all non-dependents. Non-dependents would be, for example, anyone who is not a child, a financial dependent, etc. So might, for example, be a brother or a mother who's not a financial dependent. The only way they can take up may be through the estate. So in that instance, you go through there. But in this instance, it's all going to go to Sally Smith. So Sally's going to get 50% of my superannuation interest. Now, again, and this is where binding death benefit nominations generally don't have that successor. So what happens if Sally's not alive? Then in that instance, we've got all these choices. It could be paid to the secondary beneficiary if we want to have one. So I've got here, no, there's no secondary beneficiary. Back to Sally. Does it want to be paid to the deceased estate for the sole benefit of the deceased bloodline or lineage, unless the SMSF death benefits trust can be established? Remember, that's the trust. So we're saying, look, if you can pay it directly out of the SMSF estate, that's preferable. Or payable to the deceased estate for the benefit of the family and the estate beneficiaries and charities. So that's not a bloodline one. This is a bloodline one with a preference going to SMSF Death Benefits Trust. Or if we go down here, deceased estate for the benefit of the bloodline children of the succeeding beneficiary to be held in trust with income to be paid quarterly, but no capital distribution until they reach age 25. So this is a building of a superannuation proceeds trust. Or any other surviving beneficiary in equal proportion. So we'll leave that one. So then we go down to Ben Smith, and he gets all the remaining super. But if she's not alive, if Sally's not alive, then it gets paid to Ben, remember, which is the grandchildren. And if he's not alive, then it goes into the deceased, which is going to be John's estate, etc. Now, if both of those are not alive, then we put in place a secondary beneficiary, which covers the same sort of thing. The nominated professional is where you put your details, ordinary estate administration fees or ordinary partner fees, have a meeting which ratifies and signs it off, and then you're basically A-OK. Then you've got yourself a nice little SMSF will, which you can use for your clients. But remember, that's used in the accumulation stage. It's not going to be used for reversionary pension. We will send you out that webinar on the use of auto reversionary pensions. So we'll pop our SMSF will, put a draft stamp on, send it out to the client for review. There's a product disclosure statement, which the trustee of the fund needs to put in place for the member. So that's okay. So we've done that job for you. In fact, most BDBNs don't have that, where it's actually required under the Corporations Act. We've got application by John Smith to accept that. So John's applying, then the trustees are ratifying. So there's your revocation, reversionary pensions, appointment of replacement trustee. We've got death benefits in the fund, Sally Smith. So she's to get 50% of the super interest. Now, just have a look through here and then we'll close it off. So this is a little bit different from most estates. What we're doing is opening up the Pandora's box or opening up the possibilities. So this benefit may be paid as an income stream, which is okay. If allowed under the super laws, are transferred directly to the designated beneficiary or any trust company person or any other entity beneficiary directs, including a transfer to the deceased member's estate, although you want to do that, to be held specifically for the beneficiary in a trust. Now, at the direction of the beneficiary or any leading member, the trustee may create an SMSF death benefits trust. Remember, we talked about that, to hold the designated bequest. The SMSF Death Benefits Trust is a discretionary trust where the beneficiary or their assigners be the trustee and appointor. Further beneficiaries to be designated primary beneficiary of the trust along with any lineage or such other beneficiaries the beneficiary includes in the constituent death benefits trustee. So the exact terms and conditions of the trust are to be determined with advice of any professional. So that's where you guys come in. Now, if it's not alive, then we saw that it's actually ticked as the deceased death benefits. We've got Ben Smith there. This is the nomination of you guys to be the monitor of the SMSF estate, a couple of witnesses' signatures, then the resolution by the trustee to accept it, and acknowledgement by the member. So that's how quick that process is. So we really need to have that for the SMSF will. I've just got a couple of questions here. Good old Daisy. Grant, in the example, is Ben an adult child? No, not at all. So Ben doesn't have to be an adult child. It can actually be a minor in that instance, and can just continue to receive the income, which is important. Can you prepare an SMSF will for Mr. and Mrs. together? No, because essentially it's like a will. You can only prepare it for one individual. Now, in our system, where we've got in LYD docs, you can do a will and an EPOA together for both parties. We haven't got that yet in our SMSF will system, mainly because I've had to cut off all development, or Abbott-Family had to cut off all development of new precedents for you until LYD docs 2 is done. So once that's done, Daisy, you'll be able to do an SMSF will for both of your clients together. So thank you for reminding me of that. And again, good old Tony, he's in there as well. Okay, so just to go through the other slides just quickly, just to see what we've got. Who controls the process we talked about for that one. The estate planning law, the driver's not the will, and you can have a look at that. Start with SMSF, so SMSF will, pensions, proceeds, trust, etc. Have a look at the little advisor. So this is what you've got to do is, client, how do you engage the client interview. We've got some really good data capture forms. In fact, I think I had a look at one this morning. If you haven't got this one, where did I have a look at it? So I was actually talking about this just recently. Okay, so it's a variation of the trust. Okay, must be. Okay, here we go. If you haven't seen this, we'll put this on the with the slides as well. I love this, the Guide to Testamentary Trust. If you haven't read or used that yourself, please make sure you do. It's a great little data capture for testamentary trusts. We've got a separate one for SMSF wills. I'm just wondering whether we've got, I think we might even have, yeah, there you go. So this also includes SMSFs as well. So have a really good, if you haven't read through this, read through it yourself and even build for yourself, because this is a fantastic one that looks after wills, estates, SMSF wills. So it's a fairly, well, it's only a couple of months old, not even that. So if you haven't read that, make sure you get that. We'll have a look at that as well. So the data capture is crucial. Review it in draft, build your documents. If you want, send it to Tony so you can build that, and then what we can do is we can do a sign off and a review of that. But generally, if you're going down this track, you want to be doing the wills, EPOA, and also the SMSF wills, so that when we come around to signing off, we've got a lot of meat in the sandwich and it saves you. Death benefit payments, there's a lot in there about their taxation, who's a legal personal representative, what's a lump sum, the relevant section references. We've then got how it's taxed, etc. If you are a financial dependent, then obviously it's not 17%. It actually goes up to be tax-free. Pensions we talk about, transfer balances and all of that sort of stuff. But again, it's taxed, if the deceased age over 60, then anyone's receiving it's also going to be tax-free. And then we go, if it's under age 60, how it's going to be taxed. That's if the original. So that's it. I don't want to hold you out. There's a lot of meat in that sandwich. This is really more like a 3-hour training session, but I just wanted to focus in and give you a bit of broad view, give you a few strategies, and more importantly, look at how that process of death benefits are to be paid out. Just follow other data capture forms on the LYD website. I'm not sure this guide to testamentary trust is, but I will put it up there in the client forms area, which is, if you have a look, let me just have a look here. If we have a look at the client forms in the Strategy Support Centre, so we'll make sure the testamentary trust one sits there, data capture. But it will, when you get, Jenny, when you get the this webinar later today, we'll make sure we include the reference to that testamentary trust. But have a look at that. That's our latest and greatest, which is really good. Cost of an SMSF will, $750, because it's quite, as you can see, it's quite detailed. It's not just a straight BDBN for the most part, as Dan would say, 99% of BDBNs except his are all challengeable. So the cost for you is you would charge retail client $750 for that one. Okay, let's stop there. We've got a few sessions coming up. Let's just have a quick look at them, our weekly webinars. We've got the distribution of your estate. Next, on the 7th of October, we've got blended families, estate planning. We've also got some testamentary trust case studies and how to. So it's good. It's a good one for you to look at. Tony and I will be doing that. I strongly suggest that you might want to do your own guide to testamentary trust, and when we come around here, you'll really jump into that one. We've got a few partner solutions coming up. We've got a fantastic one with Susanna Bransgrove, who's going to be looking at family negotiations in terms of succession planning there. And Mick always has his ones on Thursday. So we've got a pretty full book on coming up, but our Light Year Docs launch 2 is scheduled for the 1st of November. So watch out for that one as well. So that's going to be super exciting. Anyway, that's enough from me and also my team. So thanks, Tony. Sorry I don't know what happened there, but this recording will come out to you a little bit later on today. Anyway, it's Grant Abbott signing off.